While you're working, taxes for the most part are automatic. You get your numbers and plug them into your software at the end of the year, and then around April you either pay a little bit in or you get some back. In retirement, it's completely different. It's all on you. You're writing checks, making quarterly estimates, and if you're not careful, you might end up leaving our dear Uncle Sam a very generous tip that you didn't intend to. So I wanted to cover some of the red and yellow flags that I see for taxes in retirement. Hey everyone, I'm Zach Lundak, an hourly financial planner at Barrett FP, and let's get into it. Warning sign number 1. If you find yourself bragging to your friends that you are paying little to nothing in tax, this is a huge red flag. You could be missing out on a big opportunity, especially if you're early on in retirement and paying almost nothing in tax. Some things that you should be considering is harvesting gains in your taxable brokerage accounts, converting assets from traditional pre-tax money to Roth assets, or just simply withdrawing funds out of your qualified retirement accounts. All of these things maximize lower tax brackets, so you get money out of your accounts at low rates, and it protects you longer term down the road if tax rates increase, or if your accounts build and you get pushed into higher rates with required minimum distributions. So if you find yourself being very happy that you're not paying anything in taxes here, you might want to take a second look at that. Retirement taxes are not a straight line. They are a minefield of phase outs and deductions that, if you're not careful, you can trip over. So some things to look out for. One would be how your Medicare premiums are impacted by something called IRMAA. So if you make too much money, you show much income on your return, then you could trip over these limits and increase your Medicare premiums going forward. I don't know about you, but paying more for healthcare is not something that I'm looking to do. Another one is capital gains. Capital gains tax rates are broken out. You can pay as little as 0% in capital gains all the way up to over 20% with a Medicare surcharge, again, of 3.8%. So you have to be careful and be mindful of how much gains you're taking in a given year. Now, it's not necessarily going to influence your investment decisions, but if you're right on the limit, you don't want to go $1 over because that could cost you. For business owners out there is qualified business income deductions, or QBI, especially if you're in professional services like doctors, lawyers, accountants, financial advisors. If you are over a certain threshold, you could be left out of that deduction entirely. Now that might be changing with the tax legislation that we're expecting in 2025 with the big beautiful bill. So that'll be something to watch. Something that we're waiting for an update on is the SALT cap deduction. It's possible that this is increasing, but if you earn over the limit in income, you could be phased out of this deduction in years going forward. I recently heard that Warren Buffett always asks the question, and then what, when making investment decisions. Same thing when you're deciding which investments to place in which investment account. Understand how much taxes you're going to pay given the tax type of account you place it in, whether your investment does great, stays the same, or it goes down. Another thing to look out for is not monitoring your portfolio for tax moves that you could be making. Like we just experienced in the spring of 2025, there can be significant volatility in the markets. And if you're not watching this closely, you could miss opportunities to harvest losses and use that to offset some of your ordinary income. Or you could, if it's large enough, you could carry it forward to future years to offset more ordinary income or future capital gains. The final thought is just thinking short term again, just year by year, and trying to optimize how do I pay the lowest tax this year. You really want to consider your entire tax liability over your lifetime and try and match things up such that when you have really high income years, maybe that's also a time when you front load some of those charitable deductions and utilize maybe something like a donor advised fund or a remainder trust for charity. Those things can be so powerful long term, especially if you're charitably inclined and you don't want to give total control of the assets to the charity right away. So over long periods of time, it makes a tremendous difference, especially when you factor in compounding. So what do you guys do to reduce taxes in retirement? Let me know in the comments things that have worked, things that haven't worked, and we'll see you next time. Thanks. Bye.